It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. It is all about managing your financial future. Thanks so much for joining us once again. Another podcast gets underway. As I said last week, this is number 12. Professor Plum is here with me.
I am.
Certified and certifiable and certified financial planner. Johnny Dean here, your host, not an advisor, but having fun hanging out with Professor Rick Plum. Nice to have you here. This is our 12th episode of Season 7, for those of you keeping track. And this will be it for Season 7. We'll take a couple of weeks here, 3 weeks, probably till the end of the year. So if you're listening live, as I said last time, and you download these and listen to them right away, we'll be back on January, whatever that Tuesday is, 4th?
I don't know.
I think Christmas is on a weekend this year. I think it's on a Saturday, which means that 2nd, 3rd, 4th. So it would be on January 4th. So we got a lot more great topics coming up for next year. It is the 4th?
It is 4th.
Okay, that's what I thought. So we'll have topics, for next year and the new rules. In fact, speaking of new rules, I should mention this. We talked last week about required minimum distributions. Now, all that strategy stuff, that all stays the same. But we just got here.
Just got wind of it.
right after we did our podcast last week. When we recorded this thing, which for us is now early November, but when we recorded this, we just got new tables, RMD tables for 2022. Professor Plum, what does this mean before we get to our topic at hand?
That your required minimum distribution amount will go down slightly starting in 2022. Now, these announcements actually came out in 2020, and they were supposed to take effect for 2021. Because what they did was they revamped the life expectancy table that we've talked about. That's how you calculate a required minimum distribution. Mm-hmm. And now they've reflected the fact that people are living a little bit longer. These life expectancy tables that we've been using have been in place for quite some time. And now with updated medicals and everything, they've redone the life expectancy tables to show that people are living a little longer. And so it's going to have an effect that it will reduce the required minimum distribution bias, depending upon how large your IRA is, a very minimal amount, or maybe a little bit more less minimal. But it's not a huge difference. Like at age 72, right now, the required minimum distribution is roughly 3.95% of your last year's ending balance. Starting next year at age 72, it'll be about 3.65%.
Starting. Depending on when you're listening to this, starting in 2022.
Yes. Okay. Yeah. If you're listening in 2022, it's this year.
Right. So they'll look at the end of year 2021 balance.
Right.
And now they'll apply this new
life expectancy factor. It's just they've redone the tables to basically show that people are living a little bit longer, and so the fact that we have a longer life expectancy means we don't have to take out quite as much in any given year. Now, the longer you live, the more likely it'll be back to about where it was before. Because, like I said in previous podcasts, if you live to be 115, the RMD is about 50%. My guess is at 115, your life expectancy hasn't extended long enough to make a difference on that one.
Well, let's see. If you're, I don't know. If you're 72 now, how many years is that? That's like 37. You never know. People, in the 2050s could be living a really long time. I don't know.
We'll see.
That. Well, anyway, so maybe
we won't see. But
well, no. Well, let's see. 20. I hope to be around then.
In 2050, I'll be 90.
90. Yeah. It could
happen.
It could happen. Stranger things have happened. Anyway, so new tables. This is
effective for 2022.
Yeah, and the only reason I'm really mentioning this, it doesn't normally matter, but because we just talked about this last week and we mentioned certain numbers, those numbers changed from last podcast to this podcast. Not a big deal. Strategy's still the same.
Last podcast, I said that age 72, your required minimum distribution was around 4%.
Which guess what?
It's still around, just not quite as close to 4%. 3.7-ish instead of 4%. I mean,
was it 3.9? What was the actual number? 3.65
versus 3.95.
3.95. Yeah. So it went down.
And I mean, how many decimals do we want to carry it out?
We don't want to carry it any more than that.
It's kind of like pi that just keeps going on forever.
Right. So there you go. That's just an update from last week's podcast where we talked about required minimum distributions. As I said, the strategies still stay the same. And
it didn't make that big of a difference.
No. But anytime they get something new like that and we talk about it.
Well, I saw in the I haven't done the math on anything else, just the one that they did in the article on the nose press. For somebody with a $300,000 IRA at the end of last year, or
at the end of 2021,
who turns 72 in 2022, it has about an $800 difference in their required minimum distribution. It's about $800 lower.
Meaning you can leave $800 more in your IRA. Now, whether you really want to do that or not is entirely up to you and your advisor, but you don't have to take out as much. Oddly enough, was that way as the more you can leave to grow in your IRA, the better. Or at least that was the assumption I had at the end of the article.
Not necessarily.
Well, yeah, so not necessarily, as we've talked in real life strategy. So at any rate, that's that. We had an email, I think it was. Somebody had asked us, and I got to tell you, in season 8, when we've got to get to these emails, I think.
Quicker?
Well, we read them, but we don't read them on the air, especially those that are saying, hey, can you expand on something? Now, normally, we will mention stuff in podcasts that we've talked about on, you do these Lucia Capital Group weekly videos.
Yes.
And for clients and anybody else, really, who has access to them, we send them out, and folks can watch strategies. And they're just little, 4-minute videos that talk about strategy. You don't really get into the topics. And sometimes people see these and they ask us if we can expand on it a little bit.
Go into more depth in it.
Yeah, as to why we want to do that. So we try to do that on these podcasts with these different topics. So if there's something you'd like us to do in a little more in depth, just let us know. But we had Larry in Fremont, California, who asked us to go a little bit deeper, if we don't mind, into this idea of 401k contributions. Now, Professor, the design of the 401k, well, it's set up by definition, and whether they meant to or not, I don't know. But it's sort of a set it and forget it kind of thing, right?
Well, I don't think it's supposed to be, but that is what it's turned out to be for a lot of people. They sign up for it, and the reality is I wish they wouldn't just forget it. I wish they would push the envelope a little bit. If they started with let's say their employer will match them 50% on the 6% of their pay. So they sign up for the free money, and they put their 6% in, and they never look at it again, which is both a good and a bad thing. It's a great thing because people don't get emotional about it, pull it out at the wrong time, and do different things. But I wish they wouldn't monitor a little bit and say, you know what, I've been doing 6 and I don't even notice it. Make it 7%, 8%. Do a little bit. Just keep pushing the envelope on the savings a little bit. But as far as strategically how the money is invested in the 401k, a lot of people just start with a certain set of funds and then never change. They just, they pick XYZ mutual fund. Maybe it's one fund, maybe it's 3 or 4 when they're in their 30s and 40s, and it's all growth because they can't touch it for 20 or 30 years anyway.
So they dial it up maybe aggressively.
And then they just forget about it, and they never go back, and they don't look at it. Every couple of years, they may look at the balance and say, oh, wow, doing okay. Leave it alone. But they don't change anything, which when you've got 20 or 30 years, and if you've got the right mix to begin with, or close to at least a growth mix, you're probably doing okay. This is where I don't necessarily agree with target date funds for the whole period of time.
Yeah,
that's a different game.
That's a whole different game, and that's another good topic to talk about, by the way.
Right, and I think more people are getting tired of target date funds. More people are realizing they're not as simple or as to understand, and they don't do as well. Anyway, that's a different, like you said, different topic for a different day. But a lot of people will pick 3 or 4 or 5 growth mutual funds, and they'll put 20% of their contribution into these 5 funds or some percentage, and they'll forget about it, and they'll just keep going. And then when they turn 60, they're thinking about, someday I might want to retire.
Well, that just to interrupt, that initial, as you said, that initial, aggressive growth, maybe 5 different funds, and you put 20% across the board on all of them equally, and they're all driving. They got the pedal to the metal and the thing to the floor and whatever. And that can be a good thing for many people when they have all that extra time to invest.
Because
and they're going to use that
time is on their side when they're doing
dollar
this.
cost averaging and all that other good stuff.
Right. And the dollar cost averaging helps out over a long period of time when the markets go down and then recover and go down and recover. You're buying more when it's low and not buying as much when it's higher. And dollar cost averaging can work.
Which is what that historically those aggressive growth funds have kind of done, right? I mean,
they have volatility. That's by definition almost.
Yeah, exactly. And so as you've got time and your dollar cost averaging into your 401k, which is, again, the helpful nature, I think, of the set it and forget it. It just automatic save, same amount or higher, however much you want to designate. So you're saying that it's okay to do that. But now you say somebody has been doing this, I don't know, for 30 years, 20, whatever, and they're 60.
And they're getting closer to retirement. So now they're starting to think about, maybe I should actually take a little more hands-on approach to this. And I've built up. I mean, I've looked at my 401k, and it's wow. Most people I know that have looked at their 401k lately who haven't looked at it for a while are very pleasantly surprised.
Well, it's been nice.
And so they're like, what do I do going forward? I'm going to retire this year, next year. I'm going to retire in 5 years, 6 years. I'm not 25 anymore. I'm 60-ish, and I'm going to retire someday, and I'm going to want to rely on this portfolio, at least to some extent, to give me some cash flow. So they've heard all the stories about, well, you take 100 minus your age, and that's how much you put in stocks or bonds. I can't remember which one. Or I should have some kind of a balanced approach. So I need to pull back the reins a little bit. I need to change my allocation from 100% growth. In my 60s, I shouldn't be 100% in stocks. So I'm going to...
Well, that's true. And because their fear is, of course, with this volatility that when they retire or close to when they retire, they're going to be on the downward side of the volatility, and the money won't.
You've built up $1 million, and you're thinking, wow, 4 or 5% distribution, they'll give me $40,000, $50,000 a year for the rest of my life. Yeah. That with my Social Security, and if I have any pension, that's going to be doable. I can retire in 5 years at that number, whatever. And then 2 years from now, your $1 million turns into $700,000.
Yeah.
Well, now that's only $35,000 a year. Now that's tighter. And so what happens and this is what happens a lot, people will do that, and they'll say, I can't afford to lose anymore, and they start selling off their money now that it's down 30%. Yeah. And now it never can recover, for one thing. But they shouldn't have been in a position where that's going to affect them in the first place. So they realize that they need to take some of that $1 million and put it into something less volatile, so that they can count on it 4 or 5 years from now when they want to retire. Even if the market goes down, that portion of the portfolio doesn't go down as much, depending upon how they invested. And they can say, well, I can use this portion to buy me time for the rest of the portfolio.
Yeah, so let's use an example.
That's a buckets plan.
It is. You said $1 million. Let's use this so it's easy to visualize. You have $1 million, but now in your 401k, and you decide I'm gonna take a chunk of this and put it into a less volatile area.
Yes.
Pick a number so you can use it.
$250,000.
Okay, so I'm going to take a quarter of this million, $250,000, and I'm going to put it in. What are we talking about here?
Well, you have a 401k. You could use a stable value fund. If you're in the federal government's TSP, you could something that doesn't have as much volatility. Now, the hard part about this is, without the volatility, you're also not going to get much return if the markets go up.
Yeah, it's stable.
But this money's purpose is to avoid going down. That's the purpose. You can't have a dual purpose. I want safe, no volatility, and I want a lot of return.
That's not going to happen.
Why don't you just wish for a little bit of tax-free coming out of there, too?
That's not going to happen. So in this example,
that's why we don't put 100% of the money there.
Yeah, so in this example, you've siphoned off at age 60. You're going to retire at 65. You've got $250,000.
I wanted $50,000 a year. If I put $250 there, I got 5 years of taking $50,000 a year out of that account
when I eventually retire. So we're going to
retire in 3 years. I've got 5 years of. So I've basically built myself an 8-year time horizon. So if the market crashes tomorrow, who knows? I don't know when it's going to go down. And nobody knows exactly when it's going to go down or how far or for how long. So I'm buying myself this time horizon. I'm going to work for 3 more years in this example, and I've put $250,000 in a safe account where I want $50,000 a year out. That's 5 years.
Safe meaning non-volatile.
Yeah. I mean, it could be, like I said, the stable value fund, something.
Yeah. Safety is relative.
Safety is very relative, but even if it doesn't earn anything, I've got 5 years. So I've built myself 8 years. Now, for downturns, that should be okay. We have had some downturns that took longer than that to recover, but only a couple. And you got to be really Murphy's Law to had that happen. But it could happen because you are Murphy's Law incarnate. But we're buying time, and that's the whole idea. So now we've taken 25% of our portfolio and put it over there, and then maybe we take another 25% and put it into something moderate, something that it's still got some growth potential, but not like the pure stock market. But on the downside, it doesn't have the sheer volatility that a pure market like in 2008, a balanced portfolio, the market went down 40% according to the S&P, whatever the number was. The average balanced portfolio went down about 25%. Now, it also recovered back to original faster than the market recovered back to original from the high of 2007. So I don't have, I don't get as much on the upside, right, but I don't get as much on the downside. So maybe I took half the money and put 25% in something very safe, something in moderately safe, and left the other 50% for growth.
Yeah. So now I've got, in my example, $500,000 in my 401k, and I'm still working, by the way.
I'm still working, and I'm going to keep working for a couple more years.
I'm going to keep contributing. $500,000 is now in that same aggressive growth in this example.
Yeah, those same 5 funds.
I got $250 in some moderate
just
volatility.
A balanced portfolio, let's call it, whatever.
Yeah, and then another $250 in something else.
Something safer.
Yeah, and again, safe is relative, I should say that. Right. I just want to make sure people know that. Okay, so now what, though? I'm still working, right, and I'm going to continue contributing to my 401k.
And what a lot of people don't realize is that they can have a different percentage for the future contributions than for the existing assets. Some people believe that if I changed my portfolio to 25-25 and then 10-10-10-10-10, that's how I have to change my future contributions as well. So basically, I'm going to match my future contributions and continue to contribute in the same percentage as I have my funds allocated. If I allocated 25% to safety, then I'm going to put 25% of my new contribution into safety, 25% to balance, 25% goes into balance, and 50% goes into those 5 growth stocks. So I'm going to put the 50%, 10% into each one of those 5 growth stocks or growth funds. That's not the way it has to happen. And actually, that's not the way it should happen.
So when I put let's make this simple for people who are maybe their head's spinning a little bit. I've got a certain amount that I put in every month, every 2 weeks, whatever it is, into my 401k. This is called new money. These are my new contributions.
You have existing money and future contributions.
So where should these current and future contributions be allocated? Now, for the last, in my example, 25, 20, 30 years,
it's been going to the 5 growth funds
I've
that you
been
picked
putting it
20 years ago.
All across the board, evenly across, throughout 100%.
You've been putting it evenly across every fund you had in your portfolio.
Right. Now, you're saying
don't do that anymore.
Don't do that with my new contributions anymore. Okay, good.
So I've got my money that's going to go in from my next paycheck and all my future paychecks. I don't get any benefit of dollar cost averaging into a fund that has no or very little volatility and also very little return.
Yeah.
I don't get a lot of dollar cost averaging from a low volatility portfolio. Where do I get the advantage? I get the advantage from volatile funds. Those are the growth funds. So the future contributions, now the money that I'm contributing today and for the next 3 or 4 years while I'm working between now and age 65 or whatever it is, the age you're going to retire, is not the money I'm going to spend in the first year of retirement. It's not the money I'm going to spend in the first 6, 7, 8 years of retirement. That's the money I already have. I safened up my existing capital because I don't want to lose existing capital. I want to dollar cost average my future capital. So there is a difference in strategy between existing capital and future contributions. So I will continue to fund those growth-oriented investments only. So depending on how you want to look at it, I'm either going to continue the exact same strategy for funding I had before I made my allocation change and only do the growth investments, or I'm going to change everything up and say I'm only going to fund the growth. I'm not going to go pro rata. I was going exactly pro rata before. I'm not going to do that anymore because I only want to use the growth funds.
So my new money now in my 401k, I'm going to only, I'm going to narrow it. I'm going to put my new funds now into only half of my 401k total
the growth portion.
The growth portion. I'm not going to be adding new money with this strategy. My new money is not going to be adding to the less volatile section. I'm just going to leave that alone.
Right. So if I'm putting $1,000 a month in, whatever, I put 500 into the safety, and then 500 into the market. The market crashes by 50%. I lost $250 of that. But then when the market comes back, I do okay. But I didn't earn anything on the 500 or the 50 that was in the safe side. Whereas if I put it all in the growth, okay, I lost 500 instead of 250. But if the market comes back, and so far we've never had a period of time, given enough time, where the market didn't come back.
So you get, quote unquote, more bang for the buck.
Right.
By putting your new contributions only into the growth-oriented
As long
side.
as I've identified the fact that this is long-term money, and by the fact that I've done this plan, I've done this strategy where I have enough money on the side, either I'm still 40 and I've got 20 years of working, so I'm not going to, and I can't even touch the 401k until I'm 59 and a half, really, 55 sometimes. I got a long time for this money. Or I'm 65 and some of the money I've already got in safety to live off of for the next 10 or 15 years, and the rest of the money, including this new money going in, I'm not going to spend until I'm 80. Or I'm 80 years old and I got a bunch of money on the sidelines to be able to take it out and cover my spending needs for the next 10, 15 years. And I still have money. I can still be invested for growth. And if I'm still working at 80, I'm still dollar cost averaging into the growth accounts.
Because you don't, as you said,
I don't get any bang for my buck.
You don't get any real benefit by dollar cost averaging into something that's not moving up or down very much.
Volatility is where you get your help with that dollar cost averaging. If you've got no volatility, all you're doing is saving, which is it's not the worst thing in the world. It's just that saving is difficult as it is. I mean, there's always something calling for money. Let's see if we can get something to help our savings, our investing. Time helps us. Let's use it appropriately.
Yeah, and this is where the set it and forget it nature of the 401k can hurt people. I don't want to say hurt, because if you're contributing, you're doing okay. It can be less beneficial to people who don't really pay attention to their asset allocation inside their 401k, or who do pay attention and say, I'm going to, quote unquote, safen up this portion, but they don't change.
But they change current and future at the same time.
Yeah.
And there is no requirement that your current allocation and your future contributions have the same percentages. And that actually takes people by surprise more often than I would expect. Because you say, okay, make sure you continue to fund your 401k in the growth. I can do that? Yeah.
They didn't know. But they thought they had to scatter it evenly throughout their entire.
Even if I've put this money over in the safety, I don't have to contribute to that safer account? No, you can contribute. You could pick new funds that you've never contributed to before in your 401k and start contributing to those. And even though you've allocated to other things.
It's just a matter of setting up your 401k.
It doesn't take a lot of management. It just takes a little bit of management.
Is this true of all? I mean, I know different administrators of 401ks, but generally across the board, you should be able to allocate new funds to wherever you want it to go, right?
I have not seen one that doesn't allow it.
I mean, if you want to be really odd and an outlier, you could say, I have one stock in there. I want all my new contributions going to one stock and leave everything else alone in my 401k.
In 401ks, primarily, there are no
funds.
That would only be employer stock for the most part. But yeah, you could say one fund. One very aggressive fund that they may have if they offer that. But most 401ks are all funds, not individual stocks. Although some 401ks do allow for what they call a brokerage link, where you can move it over. It's still part of the 401k, but it's a self-directed brokerage account where you can buy stocks all you want.
Well, and is that common too, I guess?
It's not. No, I mean, I wouldn't say it's common.
Yeah. It's
more common today than it was 20 years ago, but I would still say it's not common. But every once in a while it's usually a bigger 401k, bigger company, and they have a link to it. But that's not a common way to do it.
Now, you can also, I assume, direct your match to do the same thing. So can you direct the match to go to a certain?
Ever since Enron, I think they've decoupled the match. Sometimes the match was only going into company stock. And that was one of the things that hurt the Enron people back in the day, because the company match went completely into and only into Enron stock. I don't know if some people do that automatically. Sometimes the match is made in the company stock. but I don't think that they can require you to maintain that company stock as part of the 401k going forward. I think that once the match is made, you're all able to just diversify away from it.
If you don't have company stock, you just work for a non-publicly traded company, and they're just matching the amount that you put in.
That's all done in cash, and you can direct that.
You can direct both the match and your current contributions, current and future contributions to
the funds that are available.
And as you said, it's probably a good idea as you get older to check your 401k allocation. Now, Professor, once you retire, once you hit age 65, let's say you did this, the day you retire, you've still got $500,000 in growth, and
hopefully you got more than that growth because it's been growing, and the safe stuff hasn't.
But you know what I'm saying.
Yeah,
you still got 50% in growth, let's call it, and 50, 25, 25 in less volatile areas. Once you retire, if you're not contributing anymore, what do you do with that? Do you continue to leave it in the
you want to have
growth
it set
areas?
up appropriate?
How do you want that to allocate?
Now you want your buckets set up appropriate. Now, again, we're assuming in a vacuum that this is your only account. You may have other IRAs, you have other accounts, but you probably want to have more than 25. It depends on how much cash flow you want to create from that portfolio, and you determine your asset allocation by the amount of cash flow that you want from the portfolio, and then you move appropriately. And probably won't be 50% at that point anymore, maybe 35, 40% in growth, and then build up buckets 1 and 2 a little bit more so that you can have the cash flow that you want without worrying about what the market does.
So you can bucketize your 401k portfolios.
Most of the time, yes. Not all of the time. Because some 401ks are still fairly restrictive on distributions. One of the biggest ones out there, which I guess is technically not a 401k, but it sure looks like one, the TSP, the Thrift Savings Plan from the federal government. When you take a distribution from that plan, it will come out pro rata from each of the funds you have. So if you had, so
you can't bucketize that, really.
You can bucketize it, but every time you take a distribution, you have to rebalance it right then, because they're going to take some money out of the growth accounts.
Systematic withdrawal is what they're doing.
A pro rata systematic withdrawal. So, but then they'll let you go back in and rebalance. So if they take, you're taking $50,000 out and you've got 20% in a growth fund, they're going to take 20% out of the growth fund. Well, right after that, you could always put some money back into it, but that's a pain to manage it that way.
Yeah.
And so some 401ks are more restrictive than others. Some, I ran into one, a big hospital group. You can set up a systematic withdrawal, but you can never change it. And so,
I think I remember hearing about that from you.
And so, but you can also take periodic withdrawals, and the periodic withdrawals can be any amount you want. But anytime you want to take a periodic withdrawal, you have to do a notarized form, and so you have to go get a. So if you set it up wrong, maybe you're taking too much money out. When you set up your systematic, you can't change it. If you set your systematic up too low, then you have to take your periodics to replenish. But you got to get a notary every time. So and that was a bigger plan. I mean, that's not a small plan.
Yeah.
So depending upon the flexibility, now they're much more flexible today than they were 20 years ago, with the online access and everything that we've got today compared to a long time ago. They're more flexible. But sometimes they still are somewhat restrictive in how they let you work things.
But you would suggest, as somebody actually hits retirement, that they go again and look at their 401k, assuming that's where they want to leave the money.
When you're 5 to 10 years out, you're starting to get yourself into bucket shape. Not all the way there yet, but you're starting to move a little bit safer. Maybe not all the money you need in safety, but it's getting there. Mm-hmm. When you're getting ready to retire, it should be fully bucketized. And whether it's all in your 401k or where you have accounts spread out, that's where asset location comes in. Which ones are we going to use first for cash flow? Are we going to do any conversions, things? But that should be all strategically planned out before you get to the day you say, I'm out of here.
How many times have we said that for different types of planning, whether it's Social Security, whether it's required minimum distributions, whether it's something like your 401k once you've retired and how you want to reallocate potentially your 401k, to do it well ahead of time. Position yourself up.
Right. And get yourself ready.
It may be too late by the time you actually have to do it.
Right. I mean, imagine thinking that you were in great shape in 2005, 6, and 7.
And you were
going to retire in 2009. You wanted your retirement date to be April 1st. You wanted a April Fool's 2009 retirement date.
Oh man.
And you say, well, I'm going to reallocate then. Well, your portfolio went from $1 million or whatever it was in 2007, and now you're sitting on $600,000.
Yeah.
Because you're all growth. Well, that makes a difference in you. That's going to leave a mark, a red mark, a red stain on your financial ledger.
Nobody likes those little downward red arrows, do they?
No.
There's just something about that.
So you either have to postpone retirement if you can, accept the fact that you're going to have less money in retirement, or cry yourself to sleep every night.
Yeah, and since you don't know which way the markets are ever going to go, it's impossible to predict that with any long-term certainty. The best you can do is prepare for what could come.
Even as recently as 2018. I'm going to skip the 2020 downturn because it happened so fast and recovered so fast. But 2018, if you were planning on retiring in the end of December of 2018, if you were all growth, your portfolio was down probably close to 20% from the beginning of the year. And you're like, wait a minute, I don't know. From the middle of the year. From June, you're thinking life is going great.
I was supposed to retire.
We hit the bottom in like December 26th of 2018. I was like, oh, man, I'm going to have to give back all these retirement gifts that they gave me. The watch is back.
I've already had the party. I can't tell them I'm coming back. Can you just continue to pay me? So that but tell me I don't have to come in.
Because my portfolio lost a bunch. Now, it recovered fairly quickly, but
we didn't know that.
We didn't know that at the time, and the emotional aspect of investing is so much harder.
Oh, I can imagine. I mean, I can't imagine somebody who's at the end of 2018 ready to retire and they saw what actually happened. I mean, I got to think many people may have panicked and said, "I'm just
sell it all and I'll deal with what's left.
Put it all in." Yeah,
I can't afford to lose any more. And that's the mentality that we have at times.
Yeah, which is, I guess, but here you go with the hindsight thing. So 401ks, important stuff.
And the strategy plays a role.
Yeah, and the closer you get to retirement, the more important it is for you to not so much set it and forget it, but to take a look at it, maybe reset your allocation, and then pay some attention to it. And again, once you retire.
Well, as you're getting closer to retirement, from 25 to 55, okay, fine. The only thing you should be watching there is, can I put more in? Can I push it a little bit? Can I, I'm used to the 6%, make it 7.
Yeah.
Okay, now I don't know, 7, make it 8, make it 9, and keep pushing the savings.
Yeah.
And then you have to decide between traditional and or Roth 401k. But those are things that you can, and you don't have to do those every day, every week, every month. You can do that every couple of years for that matter if you want. But as you get closer to retirement, you're going to want to start looking at the overall and saying, I don't want to lose what I already have. I want to maintain at least this level of cash flow. I'll keep some money in growth so that I can continue to hopefully get better results. But just in case, and I don't know when that just in case is going to happen, and nobody does, I want to make sure that I can keep what I've already built up.
Yeah, and that's all part of strategizing, which is what you need to be doing. Just to reiterate, as you get closer to retirement, it becomes much more important. When you have the luxury of time, you can make some mistakes, or things can go up and down. But as you start to run out of time, and you're going to need that money much more quickly than you thought, it's better to have somebody take a look at it. The folks at Lucia Capital Group, the advisors, can and will help you out with that. You just got to let them know. Give them a call, especially if you're a client and you think, well, hey, maybe I do need to review this one more time. Give them a call, 800-644-1150, 800-644-1150. Talk to the folks at Lucia Capital Group. They'll help you out. You can also go online, all the many resources they have there at luciacap.com, LUCIACAP.com. And I should remind you, too, to subscribe to this podcast. This is the last episode of this season, but heck, you can go back and listen to all the great stuff that we've done this entire year of 2021, and we had some really good topics, and we'll expand on a few more of them perhaps going into the new year. But go to Spotify, and you can find our podcast there, subscribe to it, and listen on a regular basis. We do love regular listeners. We really, really do. All right, we're out of time. My thanks to Professor Plum and the entire team behind the scenes, Adam Clark, Jeff Davis, Chris Olstad, Emily Pop, Sandra Forkner,
Yeah.
making sure we say everything that.
Oh, they've got a curtain call going here.
Well, I should mention this because, we don't just record. This isn't a set it and forget it. Maybe it is for us. We record it, and I do some editing, but after that, this goes through all kinds of machinations. And
compliance, for that matter.
That's right. So I had to throw Sandra and everybody else in there. So I appreciate all of their help in getting this podcast on the air as well. Out of time, my thanks again to Professor Rick Plum, Certified Financial Planner Professional, CFP type. I'm Johnny Dean, your podcast host. Thanks so much for listening. Enjoy yourselves, and we'll talk to you again in the new season.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Stable value funds can be viewed as an alternative to money market funds. However, there are important differences, and stable value products can be complicated. Unlike money market funds, stable value funds are typically not registered with the SEC. In addition, they are not guaranteed by the U.S. government. The structure of or investments within stable value may vary, and it is important to consider these differences in selecting a stable value fund. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. A dollar-cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.